what we're looking to do is purchase a property from a commercial business who's selling, right? And usually these deals are brought to us by brokers and even private equity firms where they say, look, we're looking to finance the growth of this business. So that being said, we're holding about $10 million in equity in this real estate that we own and operate in. We don't want to move. What we'd like to do is sell the property and simultaneously lease it back. So they're going to sell to an investor. That in that case, it's us. We at closing are simultaneously executing a 15 to 20 year absolute triple net lease. Now, I'm basically creating this passive cash flow machine, and there's a lot of negotiation that goes into that. There's a lot of legal back and forth to finalize terms of not only the purchase, but also the terms of the lease. So there's a lot of work up front, but once you close, it's very much set on cruise control. I have this contractual agreement with a credit-worthy tenant who's going to pay rent every month, and they're going to take care of the property.
Good morning, everybody, and welcome to the Real Estate Vibe Show. I'm your host, Vinki Loomba, and today I have a very special guest, my good friend, Drew Wahlgren. Drew is the Vice President of Investor Relations, managing both equity and lending relationships at MAG Capital Partners. MAG Capital Partner is a private investment firm specializing in triple net industrial real estate investments. Drew joined MAG Capital Partners in 2019 after 8 successful years as a risk analyst and program manager at Liberty Mutual Insurance. He holds a Bachelor of Science in Finance from California State University. And he moved out of San Francisco, actually. He used to be in San Francisco. Now he's in Dallas-Fort Worth. And today we'll be discussing with Drew investing in current economy. Welcome, Drew, to my show.
Hey, thanks for having me. It's a long time coming. I always enjoy talking with you, Winky.
Likewise, Drew. I'm super excited for our conversation for today. So if you don't mind, would you please share with me a brief background for yourself? What made you who you are today?
Sure, I'll try to make it brief. I guess you could take it all the way back when I was about 19, really. I was working, for a moment, part-time for my parents had an auto shop. So I was sort of brought up around entrepreneurs. They owned a shop. They're very blue collar. Worked for them as sort of an apprentice technician while I was going to college. And, I got into a little spat with my dad. He fired me, right? Very typical kind of family argument. And we said, okay, forget that. And at the time, I had been doing a little side work for a friend selling drinks to gas stations and so on and so forth. And I had another friend who knew that. And so I told him, got in an argument with my dad. He fired me. We're having a laugh about it over a beer. And he goes, why don't you come work with me? So he had managed a distribution company, and I went to work with him, and we ended up buying the company from the owner who owned, serial entrepreneur, owned about 10 companies. So we bought this one. He said, take this off my hands, get it out of here. I want more space in my warehouse for my other businesses. So we took that and ran with it. And so that was a really, coming in as a 20-year-old, actually, at that point, owning a business and, doing, making those mistakes you learn as a 20-year-old owning your own business, where I hired my friends, we would do stupid things while we were working. We were just almost having more fun than we were working, but still, putting in 14, 16-hour days sometimes. But that was, just having some pride and ownership and learning some of these things. Some of them, again, the hard way, right? Taking cash on delivery as I was distributing drinks and chips to delis and cafes and learning not to give credit terms, right? And, that was advice that a mentor had given me. And I started to go against that a little bit, slide slowly as people asked for some credit terms. And then, about 2008, the financial crisis hit and about 40% of my customers went out of business. So I said, okay, I had left school to run this business. And so I came back. And, that was after 4 or 5 years or so. So I came back, finished a degree, ended up, after a couple of different things I tried out, I moved into sort of corporate America. And I always had that itch, right, for that entrepreneurship. But at the time, I had bought my first home and really was a fixer-upper, right? I put in sweat equity. And so I really never thought about real estate too much. I thought, hey, I'm going to build a house that I like for my wife. And eventually we had kids and proceeded to go through that a couple times, right?
Mhm.
And each time making a very nice return, which I did not see that as an investment, and really saying, wow, okay, if I live in this house for a couple of years or more, I can make a very healthy profit after putting in a lot of work and some money too. But really seeing kind of a live-in flip sort of return there and coming tax-free. Again, anything over, under $500,000 in capital gains, if you've lived in the house for over 2 years, is tax-free. So it's a
Mhm.
really powerful tool, although it's anyone who does that, God bless their families for putting up with it. So it
Mhm.
was not a strategy I was taking on purpose, but something I felt like, hey, let's make this home our own. And, the money and the time doesn't go wasted. It goes into something. Well, that came back to me, many times over. And it helped that the market was increasing. So during that sort of time when I moved into sort of cruise control mode, I was saving very at a healthy rate while I was at corporate America, right? Putting money to my 401k at a much, 3 times as high as I really needed to get their corporate match. I was doing this real estate work and really deciding after just a few of these, realizing, hey, this is not the way, I could expand here and start to take this capital and, push it into more single family homes to rent out. And I really chose to go on the more passive route. And that was something that was sort of identifying my own weaknesses at the time, right? I said, I don't want to own houses around here. I will be too involved. I won't have any time for my family. I won't have any time to focus on my career, which at the time was treating me really well. I was getting a lot of opportunities there. So, fast forward, I was, at this point, investing as an LP, a passive investor with syndications, right, with different sponsor. And it helped that my older brother worked for a firm that raised capital, and they were sort of a co-sponsor with operators. And so he was making some introductions to me, early on. So I had gotten a lot of experience. And one of those companies that I've been introduced to that I've been investing with was Mag Capital Partners. So 2019, I joined as well as my brother at the same time. We came over to the team and, we had partnered sort of informally before that. And we said, you know what, this is really an investment strategy and a team that we really believe in. And we had this mutual, relationship that was really healthy. So came on board in 2019 and really just helping with the equity side, but also the debt side as we, seek to kind of expand our relationships with lenders, but also equity investors, passive investors like myself. So it's fun for me. I mean, I've been doing that to this day, talking with investors about investing passively. And I can share my story, right? Here's why I did it. Here's why it worked for me. And it doesn't work for everyone. And also, here's why I was attracted to this strategy, what Mag Capital Partners specializes in. This is what attracted me. And I've written many checks into our deals. So it's helpful for investors, I think, to see that from a fellow LP investor going, hey, these are things that I identified. I'm speaking as an investor, and I know I'm coming from a sponsored team, so people take that with a grain of salt, but at least I can articulate what is attractive to an LP investor that we bring.
Wow, that's great. And it's like kind of hands-free kind of thing, and you're making your money work for yourself, which is awesome. And you were with the Meg Capital at that time when we met first time, right? At that time, you just started maybe.
Yeah, that was late 2019. I've been with them for out of 4, 5, 6 months, something like that.
Nice.
And you and I met at the holiday party that year. So, you
Exactly.
know, when things were rosy and it was, rainbows and unicorn before COVID hit us all, right? So
That's
it's
true.
fun to think about those times.
Great. So how was that journey like? You just started, it was rosy, colorful at the time when we met first time, right? And then the COVID hit. So how did that affect you or the Meg Capital or your personal finances or your personal investments?
Yeah, good question. My personal investments did fairly well, actually. There was a
Mhm.
little bit, I mean, all things considered, right? There was certainly some hesitation from a lot of sponsors that I invested with. Even when they had properties that they were managing that were performing, everyone took a lot of caution. They said, we're going to hold off on distributions. We want to keep our account, this LLC that owns the real estate that I have membership interest in, right? We have a bank account here at this LLC, and normally we would push through cash flow right to you. But in this case, we're going to pad our reserves. We don't know what to think at this point. So, but all the investments I had with Mag Capital on the industrial side, at that point, I wasn't just sitting as an LP. I was really day-to-day information come in when typically LPs will get, monthly, but usually quarterly updates on what's happening. So, it was interesting to be on the GP side and kind of watch each week develop as we were picking up the phone and calling our tenants. And, investing in industrial real estate was a great place to be, right? We couldn't foresee COVID happening, right? No one did. But we were in a really fantastic place to have, tenants that were manufacturing companies, that were food producers, that were considered critical businesses that could continue to operate, make money, pay their rent, right? So we had a couple people kind of, sort of go, hey, we're not sure, because they just didn't know what was happening on the ground. But within a couple months, really everyone understood, hey, these tenants, at least, we're able to continue to operate, and thus we can pay rent and continue to push forward. So really good place to be. So we feel really fortunate. There's plenty of other operators who are in terrible places to be. But, that being said, raising capital for some new deals. I mean, we closed on a deal in early April. Can you imagine that? 3 weeks after COVID started, and we closed on a piece of real estate in upstate New York. And raising capital was interesting, right? Calling our investor group and people saying, absolutely not. I'm staying on the sidelines. I have no idea what's happening. And other people taking a lot more measured approach, right? Saying, hey, I'll evaluate this deal. Okay, I see a piece of real estate. It's industrial. That particular one was a frozen foods manufacturer sold to Sam's Club and Walmart and Target. So, smaller business, but certainly healthy, very healthy demand. And at the time, if you remember, grocery stores were getting cleaned out. So people looked at that and said, look, this is a tenant who's going to do very well, and they're not seeing demand. Well, demand for that company's product went up 30 to 40% over the next 6 months, right? I mean, they couldn't keep product on the shelf. So it was a very good investment. The real estate was cold storage, which is always very high in demand because it's so cost prohibitive to build. So I could go on and on, but that was one particular deal that came right on the heels of COVID. And so it was interesting to kind of interact with our investor group and see what people were thinking.
That's good. So let me ask you this. What was your existing investors' reaction during the COVID? Like you said, they were like a little bit hesitant to go ahead with the investments. So maybe this was the new investors. How about the existing ones? What was the feeling right there?
Yeah, we certainly had some new investors that were, cautiously looking around. And what you found, during COVID was there was a lot of new investors. And of course, stimulus packages started to roll out. There was a lot of people very liquid, and they were starting to explore. They had time, they were at home, mm-hmm. They weren't busy driving around the kids to sports or whatever mm-hmm. they were doing before. So, all of a sudden, I feel like the passive investing landscape really changed, actually. There was people used to just invest with people they sort of knew in their local community, through friends of friends. And now people are really seeking and going out there. And this already existed to a certain degree, but it really ramped up during COVID, right? People were going, hey, let me go look at what's out there. And now I have this capital. I'm not going on vacations. I'm still making income. I'm working from home. What do I do with this, right? I need to be investing. So they started to network more. So we did meet a lot of new investors. But yeah, during that, again, those first 6 months or so after March 15th, when, we had the 15 days to slow the spread, right? There was again, a lot of people who were, on the sidelines, and it's very similar to now, right? I'm meeting and talking with a lot of our existing investor group who are saying, hey, I'm pumping the brakes a little bit. I'm sort of surveying the landscape. And then others who are saying, hey, I'm pumping the brakes in certain areas, but certain real estate deals, or maybe all of real estate, or certain equities, I am pulling away from. And you should, right? The economy is shifting. You should pivot a certain amount and really reevaluate every asset class and every asset type you're investing in to say, hey, does this make sense looking forward? If I think this is going to happen over the next 2 years, is this a good place to be or a bad place? Or maybe I don't mind because I have a 10-year horizon, right? So everyone's going to look at it differently. So I talk to many, many investors who have been, with us for a long time. And I love hearing their feedback, right? They go, hey, here's why I am investing, or here's why I'm not. And that's my favorite part, is to hear that feedback.
So compared to the other asset class and the industrial, which would you pick, and why you think industrial is stronger? I know your focus is industrial. Yeah. So if you put that aside, you're not being biased, what would you pick between the two? I mean, not two, like more than two, whatever asset classes that we have. multifamily, and then the mobile home parks, industrial retail, what will be your first pick?
Really, I mean, if you look at across the last 5 years, multifamily and industrial have been right up there, number one and two, depending on the study you look at, right? One will be higher than the other. And probably right behind that is self-storage. And then you have a few other asset classes. And, I'd say I'm most bearish on urban office. That is just, you used to be a question mark, and now it seems very clear that there's no turning a lot of that around. So we won't get into that. But as far as asset classes that, I really like, I like alternative asset classes. I have some multifamily, don't get me wrong, I like it. Sometimes it can feel a little crowded. It just depends. The thing is, it has such great fundamentals, right? Multifamily, there are people who have thought multifamily was going to be overcrowded 2 years ago, and they were very wrong, right? So we've seen a lot of people have a ton of success, and the price of buying a house, a single family home, has been really prohibitive to a lot of would-be homeowners, right? And now they're renting in a multifamily property. So there's a lot of good fundamentals there. We like industrial. There's really some very nice long-term trends. So, I mean, I just had a conversation with one of our founding principals, Andrew G, the other day, and I said, hey, it's interesting. Even us as a company, when we first started, had a slight pivot and moved very early to industrial real estate. But we're talking about, hey, what do we think? Is there a position or excuse me, a time that we feel like we may have to pivot? If it becomes a crowded space where there's not the same kinds of returns that we'd like, and there's some vacancy and weakness, it would make sense, right? You don't just hold on to an investment strategy just for the sake of doing that. So, and really, there's the biggest macro trend is really the rise in e-commerce, right? As total retail sales in the country go, a percentage, which is in the high teens today, is e-commerce retail sales. So even during the pandemic, the very peak of it got to about 23-ish% of total retail. And that was at the height. We're talking about like May of 2020, right? So that being said, the question for anyone who's listening is, do you think that e-commerce retail sales will be a higher or lower percentage of total retail sales, right? And I haven't heard one person say it's going to be lower, right? We all agree that it's going to be more and more of a part of our shopping routines, whether that's groceries or whether it's even services. Yeah, exactly. So a lot of these that activity is all needs the support of industrial real estate. So that's a huge macro trend. And then the other one that's kind of behind it, a little bit quieter, is the onshoring of manufacturing. Now, this isn't brand new to, since 2020. This has been a trend we've seen since the early 2010s. It's been coming, slowly, but that pendulum is swinging back, right? It used to be very popular in the 80s and 90s and in the 2000s a bit for offshoring. And now companies are starting to realize that we need certain supply chains, need to be shorter, need to be stronger, need to be more reliable. And then COVID really, like many things, put a light on that and really showed, hey, this is actually a weakness in your operation. So a lot of people are starting to realize that. And an example I would use, and this is something that was kind of in the headlines, is if I'm a automotive company, I could find plastic resins from a number of different suppliers around the world. It's very easy to pivot, right? I need, black plastic resins of this specification. You can get it anywhere. However, if I have semiconductor chips, right, this takes a long time to engineer, design, and work with the supplier to develop the product that you need. I can't pivot easily. So, that was in the headlines. We all saw that. So think along that lines when you're thinking about what would cause someone to bring their manufacturing back home. It's not going to be all of it, right? I'm going to be able to get plastic resins cheaper from Brazil than manufactured here, probably. But some of these critical pieces I need to bring home. So a lot of that's been happening. And, a lot of our tenants are manufacturers. They're food producers, they're fabricators, and they're B2B businesses. They aren't public-facing companies, right? They sell to other businesses who need these parts or materials or what have you for whatever they're doing. So that's really key here is those companies are looking to a lot of our tenants to say, hey, I need someone local who I can rely on, who I can depend on for our operation here. So there is a lot of strength in being able to have suppliers close by, and those are our tenants, and there's more and more of them that are strengthening because of that trend.
Yeah, I love that. I mean, they're bringing all the business back. Offshoring, they were doing it because of the cost effectiveness. So I'm pretty sure that COVID has taught us a lot, and a lot of things needs to be done in-house. So let me pivot a little bit over here. Let me ask you this
Yeah.
question. So your tenants are like you guys do single tenant lease, or how does that work?
Yeah, more specifically, we're investing in single tenant net leased industrial real estate. So when people say net lease, they're typically talking about triple net. We typically lease these properties with an absolute triple net lease. So all of those responsibilities fall on the tenant. And those responsibilities would include insurance, taxes, maintenance, even capital expenditures on the property. So virtually everything falls onto their responsibility. So very passive investment for an operator, not having to put aside CapEx reserves and manage expenses. It's very passive there. And we like that. We're able to close on a property. And instead of starting, a lot of work there to, improve the property or whatever it is in the business plan, we're able to continue to scale and keep acquiring more and more properties without getting, mired in all of the details of CapEx improvements needed.
Oh, so basically, you're just doing the gross rental thing, right? And then
Well,
rest,
so,
everything, the triple net is taken care by the tenants. Okay, that's good. So
exactly.
can you enlighten me a little bit on the investing strategy for the industrial?
Yeah, our strategy is really specific. We do a lot of sale leasebacks. So what we're looking to do is purchase a property from a commercial business who's selling, right? And usually these deals are brought to us by brokers and even private equity firms where they say, look, we're looking to finance the growth of this business. So that being said, we're holding about $10 million in equity in this real estate that we own and operate in. We don't want to move. What we'd like to do is sell the property and simultaneously lease it back. So they're going to sell to an investor. That in that case, it's us. We at closing are simultaneously executing a 15 to 20 year absolute triple net lease. Now, I'm basically creating this passive cash flow machine, and there's a lot of negotiation that goes into that. There's a lot of legal back and forth to finalize terms of not only the purchase, but also the terms of the lease. So there's a lot of work up front, but once you close, it's very much set on cruise control. I have this contractual agreement with a credit-worthy tenant who's going to pay rent every month, and they're going to take care of the property. That is a lot of contractual value added on the front end of this. And we're going to be able to achieve yield, cash flow that's pretty strong in the high single digits typically, and be able to have that over the course of 15, 20 years with annual rent increases. So being able to insulate ourselves from all the expenses gives you a very predictable cash flow. So that's our strategy. And to get even more specific here, the types of tenants we're talking about are private credit tenants. So these aren't Walmarts or Lowe's. As much as those sound great, they trade at, a 4.2% cap rate or what have you. So if you're interested in safety without much cash flow, that's there for you, right? That's not what we're interested in. We're interested in taking a very measured, calculated risk with a private credit tenant and much higher yields where we can acquire properties, today that cap rate moving, up into the, mid 7s to 9% cap rates up there. So we're able to find that and really mitigate the risk by diving into that tenant's financials. We spread their financials. We look at the team. We look at their customer concentrations, their debt levels. That's really important today, right? If they have some variable rate debt here, they could find themselves as a profitable company today. And 12 months from now, if the interest rates continue to rise, they might be, in the red, right? So that's, something to look out for. So we spend a lot of time there and we find that, hey, we're able to get a really nice yield on this property, but this sort of this inherent risk with this unknown, again, private credit tenant, meaning they're not publicly traded. There's no Standard and Poor's credit rating on them where I can see, oh, CVS is a BB minus credit rated company. I know exactly what the risk is on the credit of this company. Here, we really take that responsibility onto our own shoulders. We dig in with our own team. By the way, we've hired a bunch of credit analysts. We're not just real estate guys trying to figure this out. We've hired professionals, we bring them in and we talk about it internally and really take that responsibility and say, okay, what do we have here? And we sign personal recourse on the debt too, I should mention. So it's not sort of a playing with risk of someone else's money. It's really, we have a lot of skin in the game here too. So that's, where that decision comes, where you feel comfortable, where is the return commensurate with this risk? This is the stuff we obsess on. And it's fascinating. I love looking at companies. So we really operate a little bit like a private equity group, right? Analyzing a business, and not just the business, but the industry. What headwinds are there in the industry? Or maybe there's tailwinds. Hey, these guys stand to make a lot of money over the next 10 years. This is a great tenant to have in place. These guys are going to grow. And by the way, if they're doing $100 million in revenue today with solid margins, okay, that's great. But if I hold this property and 4 or 5 years later, they're doing 250 million in revenue through organic growth, through acquiring other competitors, all of a sudden I have a much stronger tenant. What do you think happens to that cap rate? It really compresses, right? That cap rate is going to depend quite a bit, even in a market that's might be flat, right? That cap rate will compress based on enhanced credit. So, that's just, we don't underwrite for that, but that's just some of the, sort of icing on the cake when you look and you hitch your wagon to a great tenant that's in place there.
Wow. Thanks for answering that. I was going to ask you that question, that if you vet the tenants, because you wanted to make sure, because that's the primary source of income that you're getting back in the rental. So let me ask you this question now. What do you think about today's economy? How the industrial gonna, strive, or how the industrial is gonna work in this current economy, or what the future looks like?
Yeah, and some of this, I do a lot of reading from, the greats, right? Morgan Stanley and Goldman Sachs. I did a lot of reading of some reports they had published over the weekend, this last 3-day weekend. And, what they're saying, and these guys have some very extensive resources, is, the pillars of the economy are there, right? So from a macro level, they don't see a major implosion of the economy. So that's great, right? Certainly some challenges, right, as we battle inflation and interest rates. But they said, look, the fundamentals are pretty strong. So that's great for what we're doing here, because the risk we're taking is around tenant default risk. So, and who are my tenants? Again, they're manufacturers. These are food producers. So a lot of these, even in a tough market, these are companies still that really almost kind of power this in society, right? I mean, you can't go get on the bus without, a running bus. That bus requires parts for replacement. And guess who manufactures a lot of those parts? This company over here. That's our tenant. They're going to continue to generate sales. And, again, as long as they're managed responsibly, and I just made up that example out of thin air, but that's the kind of, you have to think about tenants like that, right? They're essential to this economy, essential to the society. Another one I made up recently was, hey, what if I was looking at a property with a tenant who manufactured traffic cones? Do you think that they're going to see a huge, valley in demand? No, of course, right? These are very inelastic industries that these companies are in typically. So that's great to see. So great to read that from some of the great companies out there, again, like Goldman, and they're saying, hey, again, there's some challenges here, but we don't see, major default rates out there. And there are going to be companies out there that defaults, right? They're going to have credit defaults because they're over leveraged, they're managed irresponsibly, and they might be tied to an industry that's a little bit more dependent on consumer trends and consumer demand, which may fall off if there's unemployment that starts to go up and so on and so forth. So that all being said, industrial's in a great place. People seem to be the trend again of e-commerce sales tends to be going up. So, all of that requires industrial warehouse space to be able to service that demand. And so, for the time being, I don't know that they can overbuild in this asset class for probably 5 to 10 years, right? And I think more towards 10 years. And that's just a prediction of mine. But they are building quite a bit of industrial, but the demand is really keeping pace with it. So they're not able to overbuild at this time.
Wow. So it looks good in the horizon. So let me ask you this. Is there any misunderstanding about industrial investing among people? You think that they might be thinking, oh my God, all the jobs are going remote. I'm not sure what's going to happen in the economy. I should not invest in this. This asset class does not look good at all. What do you think about that?
Yeah, good question. I think the biggest misunderstandings are all industrial is sort of Amazon last mile warehouse delivery centers.
I know.
They're not. But I mean, that's where all of our minds go, right? We think, that we would call that, and there are many 3PLs, right? That stands for third party logistics companies. So these are big warehouses that take on products from all kinds of companies and they just manage it. They stow it away. They bring it out to the docks when they have a truck that wants to take it out. And those companies are fantastic. And if I had a property with Amazon or a successful 3PL tenant in place, there'd be very little to no risk. Then again, that's okay, but you're going to go with institutions who are going to bid that down into a 4% cap rate. So there's not a lot of yield there, but it's very, very, very safe. And, again, what kind of investor are you? Maybe you want that, but again, that's not going to do a lot of yield, especially when inflation's eating up about 8% of your money every year. So that being said, yeah, we find a lot of opportunities with manufacturers. And this is just a space where people just don't understand. It's on the other side of the train tracks. You don't drive through that neighborhood. But if you did, even then, you would drive through and you would see signs that would say, LTV, that sounds like loan to value, LTZ, let's just say, holdings, right? And you would say, I don't know what that is, but there's a giant warehouse, 500,000 square feet, and it just says LTZ holdings. What is that? That's one of these companies, right? They're very quietly doing hundreds of millions a year in revenue and very successful businesses and just quietly paying their rent every month. So wouldn't you like to own that piece of real estate, or at least a part of it, right? If you're a passive investor, and rely on, hey, as a successful company pays their rent on time. Why? Because they do $500 million a year in revenue and are very profitable. So that's a secure place to be. And if I can get that and make, high single digits and make a profit on the back end too, through the sale leaseback and value creation on the front end, fantastic. So that's what we see out there.
Great. That's super awesome. Thank you. And now you have started a fund too. Let's talk about that next time in the next episode. Just love to learn about the fund structure as well, because we are a little bit out of time. So please share one golden nugget with my audience.
Oh, one golden nugget pertaining to what exactly? I would say
whatever worked for you in your life, any life experience, anything, investment related, anything, whatever you think is going to help the audience.
That's a great question. I would say continue to learn. I mean, I've benefited so much just from podcasts like yours and others, and just listening to hosts and guests, right? You hear all kinds of people. So keep your head down at work, but also your eyes and ears up and listening to what others are doing. And I mentioned, potential pivots in the future. Don't get too blinders on into what you're doing that you can't pivot. Remember, the world is changing around you. Be willing to change with it.
That's true. Change is the law of the nature, right? Change is always good. So pivot. That's a golden nugget. Awesome. So this brings us to our rapid fire round. I'm going to ask you 5 questions. You have to answer in 1 word or 1 sentence only.
Okay.
What is one of the most important things that you have learned in your life, and how did it change your life after learning it?
Oh my gosh. I'm looking for a near-death experience that I have in my history, but I don't have any of those.
Really? Wow.
Well, a couple near-death experiences that were my own doing. I would say really, I'm old school. I believe in hard work. I believe in putting in the time. Obviously work smarter, not harder, but you can do both really. So, put in the effort, and this country has so much opportunity to offer.
That's so true. Yeah, no matter where you are, there's so many opportunities. It's just like seeing the challenges as opportunities. What is something that you have read or recommend to my audience beside Rich Dad Poor Dad?
I am currently reading Am I Being Too Subtle by Sam Zell, sort of famous real estate billionaire. And I'm listening to the audiobook, and he narrates it himself, and he has a very raspy voice. He kind of sounds like Louis Anderson. He's pretty funny to listen to, and he's just kind of an old quirky guy. At this point, he's older, but fantastic. And I think what he says really resonates with what we do, which is when other people are zagging, you can zig and look around in that area, and that's where you'll find opportunity.
Great. In 1 word, what does life mean to you?
Family.
I love it. What is your biggest passion?
I think it might be woodworking right now. Been doing a lot, building little things. You do enough work in front of a screen. Sometimes I need to make something tangible that I can put my hands on. Good.
So the last question, if you could turn back in time and talk to your younger self, what would you tell yourself?
I probably would have told myself to pick a focus earlier. I would say, find something. It doesn't have to be perfect. Jump into it, both feet forward. You can always pivot later. But that was something I feel like I spent too much time in my younger days sort of waffling around, looking at a lot of different things, sort of being unsure. And I tell anyone younger than me that's looking for advice, I tell them, I say, look, the amount that you can do between the ages of 18 and 25, if you're focused, is amazing. It's absolutely astounding. But most people 18 to 25 sort of squander those years, and it's part of life. You figure out where you're going.
Great. So how can people reach out to you?
Yeah, they could send me an email if they'd like to learn more about what we're doing here, or even partner with us in some form or fashion. My email is Drew, DREW, at MAGCP, like MAG Capital Partners, MAGCP.com.
Great. I had a great conversation with you today, Drew. I would love to have you back one of these days again. Thanks for being on my show.
Yeah, thanks for having me. It was fun. Thanks, Winky.
Thank you.